Welcome everybody. This is a new session of our DI seminar online. Today it's a pleasure to introduce our first speaker, Stefano Marmi from Scuola Normale, Superiore in Pisa. And he will try to, I think, give an answer to these questions. So why are dynamical systems and ergodic theory relevant to economics and finance? Please, Stefano.
Okay, so first of all, thanks a lot for the invitation to talk and to give this seminar. Yeah, I will try, but I'm not sure I will succeed. The title is is over ambitious. So, and the promise is way more than what I will be able to deliver. But I will do my best. But the expectations are maybe a little bit too high. So the first thing I want to say is that what I'm going to describe today is a point of view. And the point of view is fundamentally that there may be some interesting math to do in modeling economics and finance, which have had a wave of modelizations using dynamical systems, mostly deterministic dynamical systems in the 80s and 90s, and since then this class of models have been largely uninfluential. I mean, there is of course a bunch of people in the mathematical economics community doing very nice and also very refined works, but the bulk of the paradigms which are dominant, they tend to be built in a different way. And this is what I will try to explain a little bit. The emphasis normally is on efficiency and on the fact that news are unpredictable, and this makes the phenomena to be fundamentally random. This is certainly true, but at the same time, the point is that economic and especially financial activity is, for good reasons, typically regulated and sometimes heavily regulated. And therefore, there may be deterministic components justified by the fact that in certain conditions, in certain market conditions, in particular in stressed markets, the number of choices that the agents can have is limited. They don't have so many possibilities. And there may also be components, psychological components, something like herding and so on. And this may justify also having a deterministic component in the models. And the other thing which is very important, in my opinion, is that the progress which has been done in the last 20, 30 years in smooth ergodic theory and in understanding dynamical systems which are simultaneously deterministic and random, where you have a deterministic and a random component. Of course, normally we talk about perturbations, so we concentrate on systems where timescales are separated, but still there has been substantial progress in this. And this, I think, has not been yet considered in the discipline and may contribute. Anyhow, I insist, and in particular, I talk about ergodic theory because ergodic theory deals with the statistical properties of the orbits, including time series analysis, and this should be very appealing to econometricians. So that is why I'm mentioning explicitly ergodic theory for this. A disclaimer, which is obvious, everybody knows it, but I'm not at all an economist. I don't know at all the relevant literature on the topics I'm going to talk, which is huge. I mean, I have a little bit of knowledge, but it's very limited. I didn't manage to confront these slides, to discuss these slides with my friends in economics. They would have probably killed me. They will do it later if they watch it on YouTube. I hope they will do it in a painless way. Okay. But my goal, just to make it clear and try to save my life, is not to say that there is no point of view developed by the economists on see this, but is mostly to try to attract the attention of the dynamical community and perhaps give a little bit of the flavor of some problems and tentatively sketch some research direction. Okay, so this was a long disclaimer. The talk will be fundamentally an introduction to data. So I want to give you numbers, give you an idea of what is the level of complexity of economics and finance. I will then describe very quickly the paradigm of efficient markets and the paradigm which is used, the workhorse which is used still today by central banks, which are dynamic stochastic general equilibrium models. And then fundamentally, I will spend a very short time, hopefully, on a little advertising break for the work that we did with Livieri, Ceccone, and Darlot, and Lucio Papini on the Jokos-Birkeland model to switch from biology to commodity cycles. And I will introduce the approach, a dynamical system approach to systemic risk in finance, which is what we have actually been working more and which will be the topic of Matteo Tanzi talk. Okay. Just to give an idea of the complexity, let me just recall some data. And first of all, let me try to move the window because otherwise I don't see the slides. Okay. So these are just figures. Okay. I thought that after all, the slide will stay there, and the figures, the sources are official sources or almost official sources. So, but it gives you an idea of the level of complexity of economic and financial systems. So the size of the economy in 2024 was 10 to the 14 United States dollars. Okay, so we're talking about $100 trillion of world GDP. And the debt is 3.5 times as much. The estimated number of firms in the world is almost a billion. I mean, it's between 100 million and a billion. And typically you have 100 times as many links connecting firms. The number of households is obviously of the order of magnitude of 1 billion, roughly, maybe more. And each household, if you make consumption links, if you think of typical consumption, you want to make a link between a consumer and the firm, then the number of consumption links is of the order of 1 trillion. Okay, so 10 to the 12. International trade, which has become a very popular topic in 2025 for the well-known reasons of tariffs, is around 30% of the world economy. 75% is made by goods and 25% by services. In the services, the third most important exporter, surprisingly, is Ireland, which 15 years ago was not in the top 10. The other are the United States and Great Britain. When you think of trading, it's interesting to note that the time scales of trading go from microseconds to tens of years. So you have something like sovereign funds and pension funds, which have time horizons of decades. But at the same time, the high frequency trading, especially in the Forex market, really uses microsecond and even less than that timescales. Okay, so it's really 14 orders of magnitude of trading scales. And more than 50% of the trading is algorithmic. So this is also something which says that deterministic components somehow could be important. Now, there are other figures that I will go very quickly on. I mean, the size of derivatives, the notional size of derivative is very big. These are impressive numbers which should be taken with a grain of salt. So then this is not 700 trillions. It's not 7 times it is 7 times the nominal, but actually when the actual economic value is not the nominal, it's way less than that. It's say 5% of that or 4% of that figure, but it's still an impressive number. And this is just to give you an idea of the percentages I mentioned for algorithmic trading and how the landscape has changed, because 20 years ago, instead of having 70% of the trading of stocks, which is made by algorithms, and 30% in foreign exchange markets and 50% in futures market. The percentages were almost zero for everything except stocks. Okay, so the revolution of algo trading has been impressive in the last 15, 20 years. And this is coupled with endogenous instabilities, which are completely missing in the models. There are econometric models which try to account for some of these things, but not in the sense that they are, which try to describe, try to at least provide the language. Okay, so but fundamentally these are phenomena which are not explained. Because they don't correspond, for example, to news. So what you find here are intrinsic instabilities which have been manifesting in the market. And some of these, in terms of local volatility, if you look, for example, at this one, which is an almost 10% crash in the forex market, in the exchange rate between the pound and the US dollar. This happens in less than a minute, which is very, very fast. And the typical volatility, time volatility of the forex markets is, let me give you the right figure. At the 1 minute scale is between 0.01 and 0.02%. So we are talking of an event which is something like, I don't know, 400, 500 standard deviations. Okay, so this blows out any possible explanation in terms of extreme event. I mean, this just means that it is something else. Okay, it cannot be. And this also is a 100 standard deviations event or something like that. These kind of things are rare, but not extremely rare. Okay, they do happen, and they do happen with a certain frequency. This is a picture from a work that we made with Bornetti, Treccani, Fabrizio, and Lillo and Lucio Carcagnile 10 years ago. And it's a comparison between 2 years. This is a picture which describes the year 2001. And this is a picture which describes the year 2013. And this has to do with synchronization of extreme events. Okay, so basically you are just looking at 1 minute time scale, things which are similar to this, maybe less dramatic, but still events which are many, 5 or 6 standard deviations out of the local variation, local volatility of the time series. And you try to see how many stocks in a certain set of stocks, which is relatively large, 140, jump together. And of course, you see some patterns which are here and also there. There is something which tends to happen. This is on the American market. So there are news releases typically at 2:30 p.m. in the US market time, which have to do with the central bank. So when there are news which regard this, you typically see large dots, which means that there are many jumps, simultaneous jumps. But basically, due to the number of algorithmic trading and strategies which mix together stocks, these endogenous instabilities have become, there are endogenous instabilities which have become much more frequent. And you can think that most of the dots, large dots that you see here, for example, these and so on, they don't correspond to any news. So these are fundamentally little earthquakes or not so little earthquakes, financial earthquakes, which happen just because of fights between algorithmic traders and in a completely endogenous way. Okay, so this this visualizes, in my opinion, quite well the change in landscape. This is almost only news, and this is almost never news. Okay, roughly speaking. There are fantastic things that you can see. This I don't want to spend too much time on this stuff, but just to show it's the description on a time scale of only seconds, I mean something like that, of oscillations in the bid-ask spread So when the most financial instruments are traded by a bid and a ask, okay? So you have two sides. One wants to buy and the other one wants to sell. And the best offer for buying is called the bid price, and the best offer for selling is called the ask price. And so you have Q curves in every instant, which tells you what is the best bid and best ask, and this is followed here. And you see that there is something which really seems like a loss of stability of equilibrium up to when you get to some bifurcation somewhere and you really have a crash. This is completely lacking any model. Okay, at least that I know. Again, there is a disclaimer. I don't know the literature. Maybe there is some reference, but I don't think there is. And anyhow, there is not a good and shared explanation of this kind of phenomenon. I am already been talking about volatility, so I will probably skip this. But anyhow, volatility is fundamentally in finance what you call the standard deviation of returns. Returns is a word that will appear again. It just means the variation of the price comparing to time periods. Okay, so you either the logarithmic returns, you make the difference between the logs, or the ratios. I didn't mention it, but I don't know actually what's Claudio, if there are sometimes questions during the talks here or just at the end, because the topic is completely exotic, I think, for the audience. So
I think everyone is welcome to ask questions, I think, whenever.
Yeah, please, let's remind this, okay? So,
also, if you don't want to, not just turn your microphone on, you can also write the question on the chat, and then I will read it.
Yeah, please, because before I get to the paradigms, I mean, this is almost 15 minutes that I've been talking. I hope some message has been conveyed, but it's a good point to stop if someone wants to ask some question, okay? Okay.
So, one question. Could some of this be modeled by heavy-tailed distributions? So suppose you have IID.
Of course.
Yeah.
Of course. There are heavy-tailed distributions. There is a huge amount of discussion on this. What I'm describing are phenomena which are still difficult to digest for the orthodox models in economics, of course. So basically, all the analysis and the evidence, and there is a lot of literature, mostly by physicists, statistical physicists, who have been approaching the topic of economics and finance. And they have a plethora of methods. There is not a general framework, okay? They don't have yet a general vision of what happens. But they basically move the attention, as I will discuss later, I hope, at least briefly, from information flows to supply and demand. So they really try to follow the money. I mean, just to look at who is buying and who is selling without talking about unobservable quantities, as it's sometimes the case in economics and finance. And of course, there is an immense contribution which comes from people coming from mostly from statistical physics, okay, but not only. I still think there is a gap between, and I think they would agree, between financial and economical theory and the plethora of observations which have been made by people coming from physics, which justifies, for example, I think, leaves some room for people coming from dynamics for looking at this stuff.
Thank you.
You're welcome. Okay, at the end of the talk, and the talk of Matteo will be concerned with systemic risk. So this is just an anticipation, but to say, because I spoke of instabilities here at very high frequency, but there are some low frequency instabilities. And a good example of low frequency instabilities are bank failures. And so this is what you see here is an histogram of which in blue describes the assets, and you have to read them on the left scale. On the right describe the numbers. Red is the number of banks, institutions, which have been failing. You can see the effect of the financial crisis in 2008. First, in terms of assets, large banks failing, and then in terms of number of smaller banks which were affected. This is the bunch of failures related to the financial crisis. And this is what happened in 2023. This is only in the US market. This is a large failure which occurred 2 or 3 banks in the US, but I just remind people, because you may have forgot it, that this also coincided almost exactly in time with the failure of Credit Suisse, which was an immense thing in Europe, I mean in Switzerland. Okay, Credit Suisse was one of the largest banks in the world. I mean, and the asset would be here. I mean, out to scale. Okay, just much bigger. Banks have typically extremely large asset, balance sheets. That's normal. So the largest bank are Chinese, and they have balance sheets of the order of many trillions. Okay, 5, 6 trillions. But even relatively smaller banks, I mean, even the Intesa and UniCredit, they have assets of the order of 1 trillion. I mean, it's not uncommon for a bank to have an extremely large balance sheet. Okay, so the paradigm for finance is mostly the Brownian motion, in the sense that when the first thing you are taught in finance classes is the geometric Brownian motion and the description of motion of asset prices, which comes from actually Bachelier, but the work of Bachelier wasn't recognized for a long time. And this is justified by the econometric evidence which was built in the 40s and 50s, which led Mandelbrot and Fama in the 60s to say that there was and actually this is not wrong. It's just a very rough first approximation to say that stock prices tend to follow random walks. I mean, nobody objects with that, except that one should take this with a little bit of care, as of course people do. I mean, but anyhow, this led first from an econometric point of view, and then from a more theoretical point of view with the work again of Fama and also of Samuelson to formulate this efficient market hypothesis, which in a nutshell says that the market's prices adjust to the flow of information. The flow of information is elaborated very efficiently by the agents and almost instantaneously. So when there is some news which affects the price, this immediately changes the price. But since the flow of news is largely unpredictable and random, then the price of the financial assets follows a random walk, and it's basically a martingale. Okay, apart from a possible drift, but I mean the idea is that it is. And this idea, which somehow became the dominant paradigm around 50 years ago, at the same time started the revolution of finance relative to economics, because it started with the Black-Scholes formula, so with the capacity of turning this geometric Brownian motion for the prices into a solvable PDE for the price of options. It made the derivatives market to explode, and has really changed somehow the shape of the economy, and has introduced the finance now finance is a very large chunk of economy in the world. Okay, so that's this paradigm, of course, has critiques already from the economists themselves. So it's a truth which is always debated, the efficient market hypothesis, and because it cannot really be true, this is something which already Grossman and Stiglitz pointed out at the very beginning. And there are a number of observations on this paradigm made by Kahneman and Tversky, who founded behavioral finance, but also by Samuelson, by Bob Schiller. I mean, there are a number of remarks. The problem is that the alternatives are still in their infancy, and they didn't somehow constructed yet a general framework of the same power of the efficient markets one. One interesting proposal was made by Don Farmer and Andrew Law in 2000, who somehow pointed out on the importance of evolution of looking at the financial markets and economics as an evolutionary system, where somehow there are different agents with different, some survive, some do not, and some dynamics which changes also the rules and so on. And then very recently, there is a point of view which is very attractive, which is called the inelastic market hypothesis, which was put forward by 2 economists, Gabet and Coyer, and which has also been adopted by probably the most prominent physicist studying financial markets, Jean-Philippe Bouchot. And this is a very interesting point of view because, as I mentioned before, it focuses on supply and demand. So this inelastic market hypothesis basically tries to say that the dynamics of supply demand dominates way more than the dynamics of information, the behavior of asset prices. And in particular, that this inelasticity has to do with the fact that little imbalances in the difference between supply and demand can have extremely large effects on the dynamics of the prices. Okay, so this is something which is somehow alternative to a point of view more information based. Okay, so much for finance. Now I can spend 5-7 minutes telling you, I mean, a very stylized and caricature description of how central bankers do their job. So what is the engine that it is run by central bankers when they want to make decisions on interest rates and of course by this affecting a lot of other things, currencies and the price of the price of assets and so on. And the idea is that they run certain macroeconomic models. So what is macroeconomics? Macroeconomics is somehow the study of large aggregate quantities. Okay, I don't know, gross domestic product, capital, employment, investment, consumption, but at an aggregated level. Okay, and you know that there are somehow booms and crashes and so on. There are oscillations, but typically the dominant paradigm which is adopted now is called the dynamic stochastic general equilibrium model, and it is which has a lot of qualities, and economists like it for many reasons, because it has there is a lot of theoretical work which provides micro foundations for this model, which means that it tries to justify under assumptions on the underlying microeconomic behavior that you end up with this kind of macro behavior. It corresponds to agents which have rational expectations and which are, however, typically homogeneous. And but the point is that these models have also, as we will see in a minute, the quality of producing time series of the kind that people can handle well in econometrics. So typically random dynamical systems and linear filters. And so they're really used today. I mean, when we talk about decisions, if, I don't know, a spike in inflation or a spike in tariffs can have permanent effects in economics, what central bankers do is to run these kind of things. So the objective of this is, as I said, to model aggregate fluctuations in GDP, consumption, investment, capital, labor, and so on. They make fantastic assumptions, which, however, allow them to somehow end up with an almost exact or almost solvable stochastic nonlinear difference equation by means of some representative agent which optimizes some utility. So there is a sort of stochastic optimization problem, which in the end gives this nonlinear difference equation, which gets linearized around some deterministic steady state. Okay, so the idea is that you have a stochastic difference equation, but there is a deterministic steady state, could be a cycle, could be a fixed point, whatever, and you linearize around it. You linearize around it, and then what you hope and what you ask is the system to have this state, this equilibrium state that now I put at the origin, to be unique and to be stable. Okay, so you hope for all the eigenvalues of the linearization to be modulus less than 1. And then when this happens, somehow you are happy and you turn your description just to the fact that there is, of course, noise. You typically assume the noise to be Gaussian, and this noise can somehow generate oscillations. So I will be a little bit quick on this. I realize that I'm going more slowly than I wanted, so I don't want to keep people for a long time. But in a nutshell, you really have to think that the picture that somehow governs is still an equilibrium one, and not only an equilibrium one, a stable equilibrium one. So the idea, the central idea is really that the economy is a damped oscillator. Okay, so this is really something which you would like to I want to emphasize. Of course, there is a lot of literature which says the contrary. Of course, there are mathematical economics models which explore a lot of other alternatives. But in the end, many of the models which are used have this ingredient somewhere. The economy is a damped oscillator, and it propagates exogenous random impulses. There are some shocks, but the shocks are typically filtered by this linearly stable dynamics. And in the end, the processes which are generated by these shocks are stationary ergodic processes, which do not even have heavy tails or rarely have display heavy tails and so on. So it's a little bit of a boring world from a dynamical system point of view, except that the reality is not boring at all. Okay, I mean, if you get hooked by economics and finance, it's like getting on drugs. It's very difficult to make detox because every time there seems to be continuous sources of surprise. Okay, I mean there is almost always something unexpected going on. Not only from the point of view of the fact that you have random shocks, but really from the point of view that the narrative and the emphasis and the aspects which lack a good explanation are very numerous. So, but at the same time, for example, when people debate now in the US, for example, what to do with interest rates and the possibility of inflationary effects of tariffs and so on, they typically do what you see here in a caricature. These are impulse response functions. So they run their dynamical stochastic general equilibrium model. They artificially put some large jump in the noise. And then they run the system. And typically, as you can see here, you see then some sort of convergence to equilibrium after, I don't know, 3 quarters, 5 quarters, 6 quarters, and so on. So this is a picture which is still somehow governing most of the important decision making. Okay. So before I make the little advertising break, it's a good moment to stop again if someone wants to make questions or can somehow, well, that is easy, show that I'm telling wrong things. Okay, I hope that I keep going then. So in the remaining 10 minutes, I would like to make a little advertising for a problem on which we have been working with Arlo, Papini, Ceccone, and Livieri, which has to do with agricultural commodity cycles. And finally, I would like to introduce the problem of systemic risk. So I will try to be very quick on both, but maybe even more on the first, since I'm just advertising a nice dynamical system problem. So what I'm about to say is really will be very quick. So talking about cycles, there is a domain on which people know there are somehow cycles, which doesn't mean predictable orbits, but still close to something periodic. And these are agricultural commodities. So in particular, the pork, meat, or the hog cycle is well documented since more than 100 years, actually 150 years roughly. And these are pictures of graphs of a study at the end of the 19th, early 20th century, This is a little bit later, but it takes data from 1861 until 1960. So it's a century of data, American data on pork meat prices, and you see that it goes up, down, I mean, something like that. And if you compute the period just by counting the number of peaks and troughs, and you're dividing the time spent by that, it's around 4 or 5 years. Okay, 4 years roughly. And this is until today, so this is 70 years. Probably you cannot read well, but I mean, it goes from 1950 to 2025. You may think that there is no periodicity anymore. You can see a jump, but this jump is just the inflation of the 70s. So these are nominal prices. If you use inflation, you try to put it in real prices, then basically there is no trend, okay? I'm exaggerating, but fundamentally there is no trend. And you see the same thing that you see here and here. Here again, the trending is mostly inflation, okay? So the fact that these are nominal prices. So there is this cycle. Okay, why do you have a cycle? I mean, cycle should be something that you can, in principle, trade out, right? I mean, if you know when the meat is expensive and when it's cheap, today at least. Okay, of course, you can say you cannot keep the meat in the refrigerator for 5 years. Okay, that's true. But at the same time, or maybe you can, I don't know the technology. But still, it's disturbing, okay? The fact that there is a cycle. And this problem is really, and here I'm not putting references deliberately, maybe the single most studied problem in mathematical economics, okay? So cobweb, pork cycles, there is an immense literature on this. It's a paradigm also for general cycles in economics. It's a simple case, but it's a paradigmatic case. It's almost the hydrogen atom of mathematical economics, okay? I mean, it's or the harmonic oscillator, you choose. It has been investigated a lot. And so there are a number of things that you can take into account. I mean, there could be irrationality, there could be unpredictability, environment, time lags, and so on. And with Arlo and Papini, we had the idea of taking a model which somehow we knew and which is almost not studied, which is, in my opinion, a pity, which was established 30 years ago by Jokos and Birkela. And it's a population model which they introduced to explain oscillation of population in rodents in the Svalbard Islands and in general in Arctic environment. But which has a number of interesting components. The most interesting components is that it takes into account delays. I mean, the fact that it takes a certain time to animals to become fertile and to be able to reproduce. It takes into account seasonality, so the fact that and this is probably something which is also true for many meat producers, that they try to synchronize the birth of the puppets, because I mean they don't have a continuous distribution of birth. And that there is in general a number of limitation of resources, which makes that the population is typically dampened when you have an overcrowding of animals. And so the description we made was simply somehow to adapt this model, which would only take one of these two integral equations, and to split into two for reproducing and butchering, because some animals are in a reproducing destiny, and others, they will only be grown to be butchered. So basically, there is no reproduction for them. And then to associate a coupling with a simple price dynamics, which is given by the imbalance between demand and supply. The demand is governed by the price, and it decreases with the price. And at the same time, the decision here of having more or less animals which will reproduce will depend also on the price at the time of the birth of the animal. Okay, so it's a very simple framework. And you can also make it random. This is what we did with Ceccon, who was a master student at the Scuola Normale, and Giulio Olivieri. So we basically started from this model and this equation for the price, and we added just a Brownian motion. So we turned this deterministic equation into a stochastic equation. All the rest is deterministic. So the coupling, it's a deterministic model coupled with a stochastic price equation now. And then this is on the left, you have the time series that you get from the deterministic model. And on the right, it's are the time series for supply and demand and price that you get for the random model. With here, you have added a decent amount of diffusion. And okay, I mean, don't be fooled by this apparently very regular or almost periodic behavior of the price, because the time series of this model is not at all has positive entropy. So I mean, numerically, the evidence is that there is positive entropy. And so the remarkable thing is that it's possible to tune the parameters decently well for having qualitatively the right approximate periodicity and the right order of magnitude of the variations. Okay, so this has not been calibrated on data. This is not a micro-founded model, so we don't have an optimization problem which is solved by our choices. But as a time series game, it may be worth a try to fit it, for example, but we didn't do it. Okay, and there is a lot of things that one could do on this model. It's basically unexplored. Even the original model of Yokosuka and Birkeland for the population of rodents in the Svalbard, it corresponds to a very serious problem, by the way, in ecology. So the model was trying to answer to a real problem there, and is essentially not investigated. It's left there. I mean, there is a work by José Pacifico, Nieto, and Vites. There is what we did, and almost nothing else. Okay, stop, end of the advertising, and now I get to the end of my talk. Any questions on pork meat? Everybody. Okay. Anyhow, let me get to the end, and let me try to say something about systemic risk. So on systemic risk, so systemic risk has to do with what I described at the beginning. I mean, it has to do, for example, with bank failures. Okay, so it is the fact that sometimes individual institutions may get into trouble, and just the action of some individual, the trouble in some individual institution can somehow generate a collective behavior, which is completely, I mean, a disruption of the whole system. Okay, so that's somehow the idea. And so I will, of course, talk only of systemic risk in finance. You can have systemic risk also in many other disciplines. I don't know, ecology or even social sciences, politics, and so on. But we will focus on finance, and as I mentioned, it's a topic which is hot because the number of disruptions of the financial systems, even recently, has been very, very high. In order to cope with systemic risk, 100 plus years ago, central banks were created. Okay, so if you read the history of banking, you discover that the last part of the 19th century and the early part of the 20th century was characterized by a very, very large number of bank failures. I mean, they were not, I mean, rare at all. Bank runs, typically, people running to the bank and trying to get the money back because they were not trusting the bank to be solvent anymore. And this was generating a lot of disruptions. So in this area, which has become an area of research particularly active, as always, after the financial crisis, not before, there are a number of contributions which somehow emphasize dynamical systems. There is, first of all, a qualitative description which comes from the work of Hyman Minsky, who put forward the financial instability hypothesis more than 30 years ago, and which somehow relates the financial market fragility to speculative borrowing and bubbles and bursting of bubbles and so on. It's more qualitative, but there is also a stream of literature of people who have tried to turn some of the Minsky qualitative description into mathematical models, mathematical economics models. But there are also Lyapunov exponent-like random matrix-like models made by Raphael Douady and Yongna Choi, who somehow built a dynamic model tracking the borrowing capacity of the agents and related the elasticities of the capacity of the reaction of this to variations in income with the instability of the system, and so somehow they introduced a sort of instability indicator, which they also applied to the sovereign debt crisis. So these are not, strictly speaking, there is not a dynamical system model for generating the dynamics, but there is a dynamical system point of view and language for analyzing what is going on. Okay, so that's what is in the work of Douady and Choi. And there are, of course, large dimensional dynamical system models which are used, and these are agent-based. So the way I understand agent-based models is that you try to build way more realistic models of the economy with many, really many degrees of freedom, something of the order of hundreds or thousands. And then you somehow, these typically are a mixture of deterministic and random dynamics. And then you try to use this, in some sense, intermediate dimensionality. Intermediate because I started my presentation telling you that there are 10 to the 8 firms, right? So if you make something with 10 to the 3 parameters, it's intermediate dimensionality, of course. And these have been used. So these are sort of large dimensional dynamical systems which economists build and use to describe this problem. There has been a very nice work by Hymans, Farmer, and others on building a random dynamical system model for systemic risk. But the work that will be the object of the talk of Matteo after mine concentrates on a stream of literature which we initiated 10 years ago with Fulvio Corsi and Fabrizio Lillo and with Piero Mazzarisi, and which has to do on developing a slow fast model, a deterministic slow and random fast model of dynamics of leverage of banks. But I think I've been a little bit long, so I think I can stop here and leave the floor to Matteo. Of course, if there are questions, I'm happy to answer.
Okay, thanks, Stefano. Before Matteo's talk, we have time for questions or remarks, or maybe also general questions.
Yeah, of course.
I have a question. I don't know if I'm sorry, I have a problem with my
Ciao,
camera.
Michele. Yes.
And the question is the following: since you talk about this synchronization phenomena, which can be observed in these very complex models, and also the fact that, and you stress also the fact that this is something, it's a sort of overall behavior that you observe when you consider these models as made by the interaction of a lot of agents. I mean, the dynamics of very a large number of agents. I was wondering if one can try to, recover this, the average model which has these cycles or random cycles or something which looks like that as a sort of mean field limit of a system, a very large system of agents in some sense. So this would at least would capture the averaging phenomenon, and then to see if, how behaves the fluctuations around this mean field behavior. I say mean field because
Yeah.
it's the only way now I can figure out how to recover this kind of system that you presented in some sense.
It's a very good question. So there are two. The only time I really mention synchronization here is mostly on this slide. I mean, which has to do with these very high frequency instabilities in stock markets. Okay, so these co-jumps, and for these, so this is a sort of systemic instability. I mean, and the number of agents is relatively large, but you have many algo traders, not immense, but I mean, we are thinking that most of this behavior is related to algorithmic trading. Okay, so that's basically the idea we have in mind. I mean, that's we means those who have looked at this problem, not just, I mean, it's not an individual opinion that algorithmic trade. But this is very controversial, of course. I mean, and it has a lot to do with the details of how the trading is done, because regulators are, of course, worried by instabilities in. I mean, things like this you don't want to see in financial markets. Okay, this kind of stuff is blows in the eyes of authorities which regulate markets. So I don't know, but I wouldn't be surprised that there are people who are looking at mean field games for modeling this. I don't know how realistic they manage to be, and I don't know how much. From an econometric point of view, there are studies of this at the level of microstructure, which are mostly done with Hawkes processes. So self-excitation, but you should take into account also flows of funds here, because when you have all these synchronizations, there must be something going on at the level of market makers and portfolios which overlap and so on. So this relates to what, for example, Matteo is going to talk about in his talk, because there will be an aspect in systemic risk when we think of what happens when you have different banks who somehow interact. And there as well, we think there may be something that can be done using ideas from mean field, especially when you have a relatively large number of agents.
Yes, maybe rather than mean fields, I mean local mean field.
Sure.
Sense
Yeah.
that it is a sort of renormalization in the interaction which gives you the feedback between the agents, I would say.
Yeah, I didn't spend one word on scaling variance of time series, okay? I wanted to give more the phenomena and less the analysis. Sometimes maybe it was too descriptive, but it was very broad. So I was trying to attract the curiosity of people. But absolutely, yes. I mean, the physicists look at this way, the statistical physicists look at these problems from the point of view that you are more or less describing. I mean, or it's part of their toolbox, of course.
Thank you.
You're welcome. Thank you for the question.
If we have other quick comments or questions. Okay, then probably we thank Stefan again. And as I said, yeah, we have 2 minutes quick break, and then we start with Matteo's talk. So it's a pleasure to have now the second speaker of this session, Matteo Tanzi from King's College London, and the title is here on the screen. So the dynamics of leverage in banks, and we'll see how they interact with an asset. Okay, thanks, Mr.
Thanks, Claudio, and thanks for the invitation. Yeah, as Stefano already mentioned, I'm going to present an example in how perhaps dynamical systems can help us understand a little bit more financial or economic system. And in particular, we're going to see in the model I'm going to describe how this can also inform us about systemic risk. So let me start by just saying what the model is. And it's going to be a model for the evolution of bank leverage, which I'm going to explain what it is in a second. Let's say that at a certain time S, we're dealing with the bank, and the bank has a certain amount of assets detained at that time S. And this is denoted by AS. And then it also has some debt, some liabilities. For example, the bank gets our money, and we are in some sense creditors of the bank. So the bank owes money to people. And this quantity we denote by DS. If we take the difference of these two quantities, we get what it's called the equity of the bank, which is just its net worth. And the quantity I'm going to be interested in this talk, and we're going to try to model, is the leverage, which is the ratio between the amount of assets detained by the bank and its equity. And here, of course, there is a typo. This should be an S. So we think about the leverage as evolving with time, and I'm going to explain in a moment how leverage evolves. But first of all, let me say what is the main principle that drives the dynamics is that banks try to maintain a fixed leverage target over periods of times by trading assets. And then within certain periods of time, instead, they try to update the value of the leverage. And I'm going to tell you later how they do that. But first, let's see how AS, ES, this other quantity can vary with this rule that the leverage has to be constant. So in this picture here, let's start from the left. We have the amount of assets detained by the bank, which is equity plus debt. And let's suppose that at some point, the assets detained by the bank increase in value. So this means that the total amount of assets detained by the bank increases, and also its equity it's increasing. And if you look at the leverage here, this is a ratio of these two quantities. So if you add something to both numerator and denominator in this expression, the ratio is going to decrease. And if banks want to maintain a fixed target leverage, it will then issue more debt to bring the ratio back to its original value. Okay, so certain amount of assets detained, assets increase in value, the bank is doing well and issues more debt and hopes to have a bigger return by issuing more debt. Now, this is just in terms of the bank, right? But then there is also the assets that are being traded. And in our model, we think about just, say, a single asset. If we assume that the trading of the bank has an impact on the price of the asset, we can expect that the bank buying more of the assets is going to increase the value of the assets up, right? So it's going to, again, increasing the price of the assets. This is going to increase the total amount of assets detained by the bank. And this somehow leads to a sort of like either virtuous or vicious cycle in which the bank having stronger balance sheets, so having like a larger amount of assets, adjusts for the leverage by buying more assets, so increasing further the balance sheet, which makes the asset price goes up, and then leading the bank to even buying more of the assets. And so this can lead to a feedback loop that just results in an increase of the asset price and an increase in the balance sheet of the bank. But the same thing can also happen on the opposite direction. So it could happen that at some point the asset price declines, and then this leads to a weaker balance sheet for the bank, so a smaller amount of assets and an increase in the leverage. And so to bring the value of the leverage back to the target value, the bank is going to sell the asset. So this is going to reduce the balance sheet, and if it affects the asset price, it's going to produce a decline in the asset price, and this can lead to a flash sale of the asset and a default of the value of the asset going very quickly down. This is something observed in the literature, and it's a possible endogenous cause of risks and of crises, and it goes by the name of procyclicality. So what I'm going to try to do now is to give some dynamical equations that describe this procyclical behavior, and I'm going to start by giving a slow-fast system model of leverage evolution with multiple banks. And this is going to be a random model in general, but I'm only going to focus on the dynamics of the deterministic part of the model. And if times allows, which I'm not sure, I will also mention something about the noisy evolution of the model, and the noisy evolution where on top of it we also have some observational noise. So the model I'm going to describe originates from the works that Stefano already mentioned from 10 years ago, and that we recently explored together with Stefano and Marco Joffredi, a master's student at the Scuola, now a PhD student at Stanford, where we try to consider the situation where multiple banks interact with a single asset. And describe this procyclicality, and in particular also try to see how the behavior of one bank can then influence the behavior of other banks that interact with the same asset. The system has two time scales. The first time scale, it's the time scale in which the banks update their leverage target. And then there is another time scale, which is the time scale in which the leverage target is assumed to be constant, and instead the price of the asset and the return of the asset can change. And we assume that the time scale in which the bank updates the leverage is a slow time scale. So this could be like a trimester type of time scale. So it's in the order of, say, months or weeks. And instead, the trading of the asset can be much faster, in the order of days or even perhaps minutes. And so this n, you should imagine it being a large number, so that this delta s becomes small. And we're going to interested ultimately in the limit when n tends to infinity. So the variables describing the banks is the leverage target at time t. And we assume to have capital N banks, so we're going to have capital N of these leverages. Each bank will have at each time its total amount of asset detained and its equity. And here these are variables that can vary with the fast time scale. And then there is, of course, the return of the asset at time s. The evolution in the fast time scale looks like this. So how much the bank I is trading at time s depends on the target leverage. So if the return at time s of the asset is Rs, this is going to be the updated value of the asset detained by the bank. So is the amount of asset detained at the previous time step times 1 plus the return. Okay, so Rs is just the addition, so the increasing price or the decreasing price if it's negative. And so this quantity gives the amount of asset detained at times s. However, this is not the desirable amount for the bank that wants to reestablish the target leverage. And so this is the new value of the equity before the trading. And if you multiply the leverage by the equity, you find the desired amount of asset. And so the quantity that the bank is going to trade is going to be given by the difference of this quantity and this quantity. And if you do some computations and you use the constraint that the previous time step, the target leverage was met, this is the amount that the bank is going to trade. Now, how this trading of the asset influence the actual return of the asset is modeled in the following way. The return of the asset at the subsequent time step, it's given by an endogenous contribution that comes from the trading. So this contribution ES depends on the amount of asset that has been traded at that time step, while epsilon S is just some noise added to the equation. So this should model anything else that is not the banks trading this asset. So how do we give an expression for ES is this, which is just the total volume traded at the time S, divided by the total volume of the asset. So this sum in the denominator is the total amount of shares, if you want, multiplied by gamma. Gamma is an important factor that it's called liquidity, which somehow captures how much the trading of the banks on this asset influence ultimately the price. So oftentimes financial models assume that gamma is a quantity that goes to infinity. So there is an infinite liquidity assumption, which would mean that the impact of the trading of the banks on the asset is negligible, right? So if this quantity goes to infinity and ES goes to zero, then the price of the asset only, the return of the asset only depends on some noise. It's like that Brownian motion hypothesis that Stefano was talking about. So taking this into consideration, this is the full expression that we get for the evolution of the asset in the fast time scale. And now this is the main assumption of our model, which is that the proportion of asset detained by a bank is approximately constant with time. This, if you want, you could also think of as an assumption on the sizes of the banks. So we assume that in the time scales that we are considering, the relative sizes of the banks are not changing much with time. And so if we introduce these new parameters that are some sort of like weights, we find that this is the expression for the evolution of the asset. So in the expression, you find that the return of the asset at a given time step will depend on the convex combination of the leverages of all the banks. And so you see that there is some indirect coupling of the evolution of the leverages of the banks via this quantity of the returns. Or I mean, I actually haven't explained how the leverage evolves, but you see also here in the behavior of the banks there is some coupling that goes through the return of the asset. And now what I'm going to do next, I'm going to give the evolution in the slow time scale, so how the leverage should be updated, and then we're going to close the equation to basically eliminate the return from the equations and only get a recursive equation for the leverage. The way the leverage evolves is by this so-called imposed, that's called value at risk constraint. A bank, in principle, to maximize profit, would like to have a very large leverage. So maybe would like to have a lot of customers giving and depositing their money. And so the bank wants then to use this money to invest and then make a return out of it. So in principle, to maximize the return, the leverage would like to have a big debt. But of course, having a lot of debt comes with a lot of risk, because if some of the assets that the banks detain go bad, then the bank loses a lot of its equity and might not be solvent. So what regulators impose to banks is that the bank should come up with models that out of these models, the probability of losing all of the bank's equity is at most a fixed hopefully not too large value. So in practice, what the banks does, it forecasts the variance of the asset for a certain period of time. And it uses this forecast to adjust the leverage target, imposing this value at risk constraint. And so in the model, actually what the bank does to compute the estimate of the variance is to take a convex combination of, say, a new updated value of the variance of the return that the banks computes in the latest trimester, say, and the previous estimated value of the variance. So this parameter omega I here, it's a number in between 0 and 1 that we can think of as sort of a memory in this process of estimating the variance. So an omega equal to 0 will mean no memory, and the variance just takes the bank takes just the latest variance in the latest trimester as an estimate of the future variance. Instead, a memory parameter equal to 1 would mean that this term now is 0, and the bank completely disregards the latest returns for the asset and only looks at the variance of the asset in the previous trimester. To impose the value at risk constraint, so what the bank does is basically fixes a sort of like expected distribution for the return of the asset, and then with this distribution computes the probability of losing all its equity. And you can think of this constraint as sort of like fixing the amount of sigmas. If you think of the distribution of the returns to be distributed as a Gaussian, you can think of fixing the amount of sigmas away from the mean, which results in an inequality like this, where alpha, it's a parameter that depends on p-var and on the assumed distribution for the returns. And finally, the expected value of the variance in the latest period is just done by a usual variance estimation for the aggregated return in the given period. So the constraint is this one. So the constraint, it's only like if you want, it's a bound. So the regulator only wants that the risk is less than something. And here what we're assuming is that the bank is greedy. So the bank is just like trying to maximize the leverage as much as possible. So given this constraint, we just pick the largest value possible for the leverage. And now you see this defines the evolution of the leverage once the time series for the return is known. As I mentioned, we treat this as a fast law system. So we think of the case where n tends to infinity. So we let n tend to infinity, and so what we get basically is that the estimator for the variance of the aggregated returns can be approximated by this quantity, where phi hat t here it's an estimator for phi t, which is this quantity, and we end up with this expression, and you see in this expression for the moment this is the only source of randomness. Phi hat t is the only source of randomness that comes from the fact that the returns are random variables. But if we take this limit n tend to infinity and we assume that this estimator for the variance it's consistent, this should converge to the expected value for phi t. And this evolution that at this level still it's a random evolution, it becomes a deterministic evolution. So this equation number one, which in truth is like n equations for the nth leverages of these banks, it's an update for the value of the leverage that depends on the values of all the leverages of all the banks, right? So it depends on the value of the leverage of bank I, of course, but it depends via this term also on the leverages of all the banks. And what I'll try to do next is to describe what kind of dynamics can emerge for this n-dimensional system. The first case, and okay, maybe I should also specify that I'm going to mostly be concerned with the case n equal 2, so the case of having two banks. And the main parameter of the model, maybe I should go back, the main parameters of the models are the weights, pi I of the banks, so how large are the banks with respect to each other, and omega I, which are the memories of the banks. We assume that gamma is something that is somewhat fixed in the market, and alpha is also somewhat fixed. And they are both like things that depend mostly on the asset and on the market rather than on the strategies of the banks. Instead, the PI, the weights pi I, they depend on the size of the banks, while omega I's, they depend on the strategies that the banks adopt to forecast the variance of the return. So in the case of two banks, let's start from the situation in which the two banks adopt the same strategy. And what we find, first numerically, but this in fact can be proved rigorously, is that the banks tends to synchronize. And this is irrespectively of the weights of the two banks. So no matter of what is the size of the banks will tend to an attractor that sits on the diagonal of the phase space. In this case, the phase space is just two-dimensional, so we have the two leverages of the two banks, and you see these are just some points on an orbit, and they all sit on the diagonal of this space. Now, for this specific case, you see the dynamics, it looks somewhat chaotic, but I mean, the main take-home message in this case is that banks with similar strategies tends to synchronize. And as I mentioned, this can be proved rigorously just by showing that there is a Lyapunov function that strictly decreases along orbits, and it's given by this expression. What about the dynamics on the diagonal? Well, the dynamics on the diagonal reduces to the one-dimensional evolution of the leverage. So the case where you just have one bank that has weight 1, so it detains all of the assets, this is the expression for the evolution. And this is the expression that was studied extensively in the papers by Stefano, Lillo, and Corsi, and also by later works. And this map, if you plot the graph, you immediately recognize it as a unimodal map that has a quite interesting and rich bifurcation diagram by changing the parameter omega. And so you see that this leverage can have all sorts of dynamics. So when omega is small, which remember it's when the bank has short memory, so it only looks at the behavior of the asset in the latest epochs. The behavior tends to be more chaotic, and of course, I mean, there is some periodic windows here, but it's with higher probability chaotic. And instead, if you take larger values of omega, the behavior tends to be more stable. So you get attracting fixed point and periodic orbits, and on the last graph you have the estimate for the Lyapunov exponents of these systems. So if you want, the take-home message could be that at least in this model, short memory tends to favor chaotic behavior of the leverage. if we take omega 1 not exactly equal to omega 2, but close, this is what we get. This is just a trajectory taken at random. You discard the first 100 iterates, and you keep the 10,000 following iterates. This is the picture. And we were kind of like happy to find this picture because it's perhaps what one would expect from the unimodal nature of the synchronized dynamics. And this looks a lot like a Henon attractor, with this difference that there is some self-intersection in the unstable manifolds that comes from the fact that these maps are not invertible. And we can see by zooming in any region of the attractor some fractal nature. And yes, this is perhaps what one could have expected from the fact that in the one-dimensional case where you have synchronization, there is some transversal contraction with respect to the synchronization manifold. And the moment you change omega 1 and omega 2 slightly, you get outside of the attractor because the synchronization manifold is not invariant anymore, and you develop this Anon-like behavior. We also give it a go of studying this somewhat rigorously, but we failed. We tried to apply some results by Laisang Yang and Wang on rank 1 attractors, but we were not able to basically fit this to their situation. This situation, our system, to their situation. There was one of the requirements there in that works that this system does not satisfy. And so we were not able to apply the results on the study of mostly SRB measures of this type of systems. So this was the dependence on omega, but then also changing the weights changes the behavior of the banks. So now we are assuming that the two banks have two fixed values of omegas and different. And now what we change is instead the weight of the first bank. So when pi 1 is equal to 1, it means that the first bank it's basically much larger than the second bank. And what we see is that for both of them, the behavior that dominates is the typical behavior of the first bank. So with omega 1 equal to 0.8 means a long memory of the bank, means stable behavior. And that's what we observe for pi equal to 1 for both banks. Pi 1 equals to 0 is the opposite case, where it's the second bank being the larger one, and you see that the behavior that dominates, it's the chaotic behavior that you would find in correspondence of omega 2 equal to 0.3. In between is some sort of like interpolation of this bifurcation diagram, where you interpolate in between the having an attracting fixed point and having chaotic dynamics, and the new bifurcation diagram ensues for the two banks where you have period doubling and chaotic behavior interspersed with the periodic windows once again. So the take-home message here is that the bigger bank definitely tends to drive the dynamics of the smaller banks. And if you have instead in like a mixture where the sizes of the banks are sort of like equivalent, then you are in an intermediate behavior, and by varying the weights of the banks, all sorts of interesting behavior can arise. So there's one situation that we can treat rigorously and say what happens is the case where pi 1 is equal to 0. So the case where one bank is negligible in size and most of the asset is detained by the other bank. And these are the equations in this case. And so I highlighted in red the leverage for bank 2, and I highlighted in blue the leverage for bank 1. So you can see that this is a skew product system where the bank number 2 has leverage evolving independently of bank number 1, while the evolution of bank number 1, it's driven by the evolution of bank number 2. And these are the plots of the maps. For the map T, it's just a one-dimensional map I also have shown before. And instead, this is the function f lambda 2 that gives the evolution of bank number 1 for different values of the leverage of bank number 2. And what we can say about this system is that there is a random attractor, and this can be proved by taking the invertible extension of the map T and constructing a skew product over the invertible extension. And furthermore, we can even give an expression for the random attracting point. So we can completely characterize the random fixed point and establish, for example, so its continuity with respect to omega 1 and other properties. This also means that in this situation, which I described for 2 banks, but in fact you can think of having more banks with weight equals 0, nothing is going to change. There's going to be the same equation for all of the banks with weight 0. What this picture shows is that there is synchronization among the leverages of those banks. So if you take 2 of the tiny banks and you initialize them at different values of the leverage, what this tells you is that if you let time run for long enough, the values of the leverages will tend to synchronize. Another thing that we can say is that from this explicit expression of the random attracting point, the dynamics of the forced bank can be deduced from the behavior of the time series of the driving bank. And so if the driving bank has periodic behavior, you would expect that also the forced bank will have periodic behavior just by disentangling this expression. And if the dynamics of the forcing bank is chaotic, then instead you would have some at least topological chaoticity of the system, meaning that what we can rigorously prove is that the dynamics of the driven bank would be topologically transitive on some open subset of the phase space. Okay, so this is sort of like end of part 1. How am I doing with time? Because perhaps I'm already over.
Yeah, actually, yes.
Yes. So
I can ask you a question about the random behavior. So
yes, okay.
If you
So
would like to give a quick picture.
Thanks a lot for the question. So a quick overview for the case of the noise is heteroscedastic, which let's just focus on this equation. The noise is depending on the state of the system by this. So it's the application of the deterministic map. This is again the case of just having one bank, and the evolution is given by application of the deterministic map plus some noise, but the amplitude of the noise now depends on the state of the system. So it's if you want multiplicative noise. And so what has been done in works by Fabrizio Lillo, Olivieri, Marmi, Solonco, and Vaienti is to study the statistical properties of these random systems. And what they could show is that there are some stationary measures under some conditions, and they have nice statistical properties, like weak stochastic stabilities. The time series satisfy limit theorems, and one can also give estimates for the Lyapunov exponents. And then the actual improvement on these results that I was also part of is the case where you, on top of the noisy evolution, you also have some observational noise, meaning that you have some time series you're observing, which are the time series for the noisy evolution plus some noise on top of it, which also we assume to be state dependent. And what we can prove is that the statistical properties of the time series xt continue to hold also for the time series that are observed, so the ones which have also the observational noise superimposed to the evolution. And that, in fact, if you try to put up a filter that tries to find xt or estimates of xt given zt, filtering is stable, which means that it doesn't depend on the priors you impose on your system. So it doesn't depend on the distribution you assume as a prior. You will always asymptotically find the same estimated values for xt, which is good news because it means that if this is the actual model describing the data, there is some hope of being able to recover the time series xt from observations in a robust way. And perhaps, yeah, I will not go into the details, and I will stop here.
Okay, thanks, Matteo. Are there more questions or comments? Actually, so if there is, Giorgio, would you like to ask a question?
No,
Okay, I see. Okay,
everyone has to have a vague perception of what he wants to say, and I don't.
maybe there is a question by Michele.
Yes, so if I well understood, this is the evolution of, I mean, in the you look at the evolution of just one bank, I mean, and the effect of the other banks is encoded in the noise in some sense.
That is the case. You mean in this case? So no, in this case, it's just the evolution of one bank. We didn't look at the case where there is a coupling between banks, and on top of this there is noise.
Oh, okay.
Yeah.
This would be interesting to see
Yeah,
if
definitely.
noise preserves.
Yeah.
Okay, thank you.
So did you mention also some behavior, some check with the real data in the contents, maybe?
So this is actually something that maybe Stefano can say more about. So we didn't do that, but it was done in this paper here, as far as I understand. There was some machine learning scheme put up to fit the model with the noise with the data. Am I correct, Stefano? Is this
You are absolutely correct. There is so there was a data set which has been used by Fabrizio, also with other collaborators, of leverage of commercial banks in the United States between it's something like 15 years of data and several thousand banks. And basically, we have so the point is that it's a model with very few parameters. So this is quite nice. I mean, and some parameters are actually impossible to determine because we don't know what the frequency of the trading is. So, and in particular, we don't know if we observe all the periods because the reporting is quarterly, but actually the banks may trade monthly and so on. So in the end, what was done was to train a neural network on with a few layers on surrogate data. So I mean on artificial data, so that to see if it was in principle possible for the network to identify the hidden parameters. And then we have fit the answer was positive, that the confusion matrix was not too bad. So, I mean, there was a decent chance of applying this to real data. And we did it. And it turned out, for example, that there is a slight dependence of the size of the probability of being in a chaotic zone from the size of the bank. And in the sense that, if I remember well, large banks tend to be more easily chaotic than small banks, which is quite surprising, or the other way around. But I'm not sure because I haven't thought about it for a long time. I'm sorry. And also the other thing is that so these are very short time series. So of course everything has been taken with a lot of, I mean, care. I mean, the time series we were fitting were 60 points. Okay, so and if someone were interested to have a look, there may be the possibility. This would be it's something I really would like to do, of extending now the analysis to data which came after, because the data set is by now more than 10 years old. It would be fantastic if what we did is somehow coherent. The analysis ex ante is coherent with the analysis ex post. So if somehow the identification of the parameters stays coherent, that would be just stunning, I think. But this is an important point we wanted to make conceptually. Sorry for the long answer, because this is something I didn't mention. By the way, it relates also with work which people do in data science. I mean, I don't know, data-driven transfer operators, for example, and with the research project of Fernando Casun, of somehow applying statistical tools to induce the dynamics. I think it's important to know that now, even if in an analytic form certain models cannot be estimated from data because the likelihood function is too complicated and so on, there are other tools which allow today to try to use noisy nonlinear dynamic models for fitting datasets and making and building time series. So the point is that for a long time, I think people have been stuck with linear models because those were the only way to go if you wanted to have a reliable tool for policy making and decision making. And this is not true anymore. I mean, it's not the toolbox is much broader. And these are explainable models. This is not just taking a block box, okay? I mean, the model has a meaning, and it's not just going for some taking a supercomputer with a lot of parameters and fitting something which has few parameters with an immense number of parameters. It's the contrary. This is a very limited, very economic in terms of parameter model. So the fact that we could somehow fit it, I think it was important, and it's a proof of concept in some sense. Now, of course, the hard part has still to be done.
Okay, thank you. Are there other questions? Okay, so let me thank Matteo again. And